So we're going to get started. This will not be a time where I'm going to bash our president. This is a fair question. It's meant to be that way. We're going to go through the next session, 20-25 minutes, and then we're going to break for dessert. I think I put in the email exchange that there is bread pudding here, and I wasn't lying, and it's worth getting up for. So in about 20, you're going to work for it, though. We're going to go through one more. And then we'll break for that, and then there's a final shorter presentation that I'll end with after this one. And this will be a little bit political, but I think it'll be fair, and I'm going to be looking at this from a market perspective, so you're not going to get a lot of opinions out of me. We're just going to talk about things that are factual, so nobody has to get nervous or look around the table and wonder if we've got, did that person vote for Obama or not? And it's okay if you did, you know. Obviously in a room this size, based on the results, some of you had to have, right? So anyway, we'll go through this, and it's a question that some investors are asking. Some investors are asking the converse: should I invest more in the market? Should I double down in the market? But essentially, what people are most concerned with, and what we're going to deal with, is that it does seem like there's an attack on free markets in the political spectrum. And I've got to start by telling you, I am not a fan of Republicans, and I'm not a fan of Democrats in the House right now. I don't think that they're leading. I think they're, economically speaking, pretty close to believing the same things. When you evaluate their policies economically, I'm not going to talk about some of their other issues, but economically they're not that far apart if we look at what they really stand for, and I'll have a few quotes later to outline that. But really what we're talking about is, and I should also say, it does not bother me if you loved that steak or that chicken, if you wouldn't get another couple pieces and just keep eating while I'm talking. This will be food for your mind and your body here while we're talking. So, but it's the intersection of these two circles that we want to talk about. How does the government debt, or quantitative easing 3, the potential for it, the global recession potential, taxes are likely or are going up on a sector of our community. The regulation has gone up with the Dodd-Frank bill and other bills. Inflation is a concern. They've been recently talking about how Fuller, the Fed chairman in Philly, has said that inflation should be moderate, should not be something to worry about. We've been shown that we have low inflation, and yet we go to the store and we don't feel like it's low inflation, right? So how is all this intersecting with our retirement, our medical care, our income, our purchasing power, and what we might leave to our heirs? So we're going to go through this together. Markets are forward-looking. We talked about this in the first session. Markets price in what it expects about the future. One of the reasons we see such huge swings in the market with such small differences is that you take a scale of 1 to 10 on any issue, and let's say we think that the government is going to raise, like I talked about before, raise the interest rate a quarter or 0.5%, and then it raises it just a little bit more or just a little bit less. Is the total environment so much less for them having done it just a little more or a little less than expected? It isn't. I mean, when you think about the economic outlook, if it was expected to be a 2 and it ends up at 2.1, there's a market shift for that. So a lot of the craziness in the market and a lot of the market shift and a lot of the news that comes at you is with respect to that 2.1 when they were expecting 2 out of 10 of something, right? So it's all on a scale. Market returns are not strongly correlated with macroeconomic variables such as GDP. This was in the email invitation. We're going to talk about GDP and whether or not this correlates well with your returns or with investments. Markets can provide positive returns even during periods of poor economic performance. And timing markets is difficult. I think we beat that horse to death last hour, so we'll not go into that in too much more detail. But markets are forward-looking. And on your table, I gave you this. So if you didn't get a copy of this, I think we have them up at the front. This is just a fun pictorial. I like to always leave you with something to take back. Since 1900, did the GDP rise? Was there growth in this country? Or did the GDP decline? Was there a recession? And 21 years out of 100 were red. If you add in the flat years as red years, it's about 25 out of 100 was flat to negative GDP growth. And the question really that we're going to ask tonight is not so much can this be predicted, but again, let's say you could predict it. The fiscal cliff we'll talk about in the next session, that's essentially a prediction of a GDP decline. They said if taxes rise and every American has to pay a little more in taxes, they're going to spend less. That'll create less spending, that'll create less GDP growth, that'll throw us into recession since our growth is so small now. So people have been predicting a GDP decline next year. Let's just say they could. We know they can't really, but let's just say they could. Does it benefit us to know that? Because what would we do ahead of a year where we thought the GDP was going to come down? If we were sure of it, we'd pull our money out of the stock market, right? We'd set it on the sidelines until the GDP was expected to go up again. But expectations, we have to remember, are all already built in. And the average investor is a pretty good gauge of what's happening. But here we took the 21 years that were negative GDP growth. So every year that was negative is listed. And we took the average of each of those GDP growths, negative growths, and the average of the negatives is negative 4.37 on those 21 years. So this is assuming you could predict, and assuming you said, I want to pull out of the market on those years because there's going to be negative growth. Well, what you'd have done over and against staying in the market during the entire period of time where you'd have gotten just over 8% return, you'd have lost the 11% return that is the average of the real returns. And here I'm using the returns from what's called the CRSP 1 through 10. We talked about that in the first session. CRSP, Center for Research and Securities Pricing, talks about stocks and gauges their results. 1 through 10 means the very small companies, the mid-cap companies, and the large companies, all of them together, and their returns, the total market return for each one of these years. Certainly some negative years correlating with some negative GDPs, but look at this, look at these, and look at this. The average return of just the 21 negative years was more positive than the return of all the years. If you decided, hey, I want to pull out of the market because I think the GDP is going to be negative next year, you'd have done yourself a disservice. That's mind-blowing to me. I wouldn't have thought that that was true. But it is. These are real returns. And we're talking about the US GDP. So we're talking about the CRSP 1 through 10. We're not talking about international stocks. We're just looking at the entire US market comparing to the US GDP. So we looked at it and said, okay, what about 17 or 18 other free countries that have free markets, that have stock markets, that have GDP growth that for a long period of time has been tracked? We did the same thing for them. And what we did is we said we're going to move to T-bills in years when the real GDP growth is negative. So when we expect the real GDP growth to be negative, and we're going to assume we're always right, we never were wrong, and we always moved out of the market just before the GDP growth went negative, and we always moved back in right after it went negative and was done and was going to move to positive again. And we went to T-bills during that period of time. Otherwise, we held equities in a full market for that country. Okay. The timing of Australia, if you market timed, you would have actually outperformed the total equities. In Belgium, if you market timed and pulled out of stocks on the down years and went into bonds, you would have done less well. In Canada, you would have done less well. In Denmark, you would have done less well. We can go all the way down this. In a few of them, you do much more than the market, like Germany. But the average difference was losing 0.5% if you look at the global situation. So on average, if you could have guessed when each one of those countries were going to go into a recession, and you were right, and you pulled out of the stock market ahead of it, and you went into T-bills, where there was safety, on average you would have done 0.5% less in your portfolio had you been invested in each one of these. I get this question a lot. Is the fiscal cliff something I should be afraid of? No. From a standpoint of the fiscal cliff has been the definition of what happens to us when GDP is expected to go down, when we're expected to go into a recession. And recessions, there's no correlation between a recession and a negative stock market return. There's nothing there that should tell you, hey, let's try to do this. And again, this is to say nothing about the fact that it's also very difficult to predict whether or not we're going to go into one. Had we needed to predict that on the 30th of November, we didn't know what they were going to do in Washington. But even if you did know, and even if you could predict it, the average difference internationally is still that you're less well off by 0.5% in your portfolio. And then the question becomes governments and markets. And so we're going to talk about the nature of our governments. And I talked about the fact that I think the Dems and the Republicans are not that far off economically. And I think what we'll see here is that that's probably true. Are we overregulated? And in the emerging markets world, there's a rise of state capitalism. You hear it pegged in the news as crony capitalism, where the state kind of picks the winners and the losers through regulation. And the question is this overregulation, or is this political game going to affect us? And we're going to answer the question. Obama's in. Mitt Romney's not. Mitt Romney's a capitalist. That's supposed to be better for us, he says. Obama's not a capitalist. Let's not talk about what he is necessarily. I'm not exactly sure the best word to call him, but that's supposed to be better for all of us, he says, right? We can take a look at the entire population versus the other guy, and is this better or worse for us? So we talk about this, though, on the standpoint of the pillars of economic freedom. Are we economically free, yes or no? Because this is something that we can track, and this is something then that we can put in the matrix and see if there's a benefit to being economically free with respect to our portfolios. So we have the rule of law, property rights, freedom from corruption. This is something that can be tracked country to country. How free are we based on the rule of law? Number 2, limited government, fiscal freedom, government spending. How limited is the government? Correlates to how economically free a country is. Regulatory efficiency. Is there business freedom? Is there labor freedom? Is there monetary freedom? Number 4, open markets. Is there trade freedom? Can we buy and sell stocks easily without getting hurt, or without being afraid that the price was set appropriately, or that we can actually turn that security in again and get paid for it? Is there financial freedom? These can be tracked, and the Dow Jones Corporation, along with the Heritage Foundation, came up with a widely accepted score for countries. And so you can see the United States and Canada are in the mostly free category. They're between 70 and 80 points on the score, 70 to 80% free on the score. The moderately free companies are between 60 and 70 points on the scale. And the totally free countries considered on this, like New Zealand, Australia, Switzerland here, and I think there's a little one down here. Oh, that may just be a lot of black lines for Chile. And a couple of, no, I think that's it. Those are the mostly free, or the totally free. And the mostly free are in light green. The repressed are the red, Argentina, Iran, Libya, Ukraine, where there's really zero freedom economically. We really can't even buy and sell stocks in these areas. The emerging markets would oftentimes be in this sector here. They're just coming into their own. They're just putting a stock market together. South Africa, Johannesburg, there's a stock market there. We have a presence there for that purpose, and they're moderately free. It wasn't 20 years ago that they were mostly unfree, and they're moving into the moderately free. What I like about this slide is that it can illustrate that even though sometimes we feel like our economy is less free 15 or 20 years ago, on the aggregate, the world is more free economically than it was 20, 25, 30 years ago. We always talk about diversifying from an investor standpoint, and I'm going to give you the investor standpoint. I don't want to appear callous. We want to care about the poor. We want to care about the marginalized. We want to care about those in the third world. You're here from an investment seminar, and you're not here for my opinions about those things. So I don't mean to just wash over those and not talk about them, but we're going to talk about investments. And from an investment standpoint, we want to diversify globally because the U.S. isn't the most economically free country. But the question then is, does that even matter? So the Heritage Foundation says that in the developed markets, like the U.S., the 5 most free countries are listed: Hong Kong, Singapore, Australia, New Zealand, Ireland, in that order. The 5 least free are Norway, Portugal, France, Italy, and Greece. And then in emerging markets, Chile, Taiwan, South Korea, Czech Republic, Mexico are the most free, and then Brazil, Indonesia, India, China, and Russia are the least free. Now let's take a look at the returns when you compare the most free against the least free. The top line are the returns, the growth of $1 in developed markets from 1995 till the end of 2011 in the least free countries. And the growth of $1 in the middle in the most free countries didn't perform nearly so well. It's really interesting. This is not what I expected. So are we afraid of regulation? The politicians know this. They know they can get away with more regulation in the long term. The stock market sees no correlation between it from a return standpoint. You look at the emerging markets, it's very similar. Much more volatile in the emerging markets. These are much bigger ups and downs when the volatility mechanisms swing, and these are all stocks. We're not taking a look at bonds mixed in. This is all stocks. And yet the economic freedom quotient, when you're in the least free category of those countries, you do the least well. So these aren't in the repressed countries because you can't own stock there, and therefore you can't make you can't get data to tell what they did. But these are in the least free countries that have a market where stocks have been bought and sold. These are emerging markets, so you're going to look at the 1998 numbers as really the earliest period of time that you have good data. So it's a relatively short period of time, but again, it tells the same story over the last 12 or 13 years. And not, again, what I would have expected. Economic freedom is correlated to a lot of things, as we'll get into, but it isn't correlated to stock prices. Higher incomes, higher longevity, lower infant mortality, better education, increased life satisfaction. GDP growth has been linked to all of those things, but it has not been linked to stock returns. So we saw that in the graph that we showed you, where GDP growth was negative for 21 years, and on those 21 years, the actual stock market returns in the U.S. anyway, and in many other countries, was on average better. But it also shows up in the countries that are looked at as more economically free or less economically free. So we're going to look at presidential returns. And we're going to look at all of the presidents since we have stock market returns. We're going to do the same for the House and the same for the Senate. Okay, so this will be fun. Calvin Coolidge was a Republican. He was a Republican in the 20s, 26 through February of 29. And during his tenure, he saw a dollar grow in the S&P 500 to $2.09, $2.09. I'm going to just have you just quickly look at the top line and the bottom line, the Fama French small value companies. If you remember, I said small value companies are where you're going to get a lot better return. And the large U.S. companies are where you're going to see good return, but not as good as the small. So you can always compare what does a dollar turn into during the tenure of this president, and then we're going to separate them out and tell you who wins at the end, Dems or Republicans, okay? You're all waiting with bated breath. Next we have Herbert Hoover, another Republican. A dollar turns into 28 cents with him. And the small value companies, dollar turns into 14 cents in that one. Now you'll need a coach then, right? We'll need to talk about rebalancing at that time. Franklin Roosevelt comes in, and during his tenure, $1 equals $4.61. We have to weight that for time because he was a president for what, 19 or 25 years, something 30 years he became president. I don't know how long it was. Was it 10 or 12? And the Fama French small value, a dollar grew to $17.03 in that category. Many people ask me what did the market do during the 30s and 40s, and are you afraid of that? Well, most people don't look at the market as anything other than the S&P 500. Most people are invested just in large companies. When you're diversified and you've got the Fama French small value bringing a dollar to $17.03 during a relatively short period of time, that does a world of good to your diversified portfolio, especially if they're being rebalanced. Hitting the wrong button here. Harry Truman, another Democrat. Dollar turns into $3.10. Small value, a dollar turns into $3.41. Dwight Eisenhower, $3.04 on the S&P, $3.22 on the small value. JFK for the short period of time, $1.39 to $1.55, so still some growth. Lyndon Johnson finishing his term. For him, a dollar goes to $1.66, and the small value goes to $4.02. The benefits of diversification show up there again for that small period. Richard Nixon, the value goes down again. Darn it, those Republicans, can they get some return going here? Fama French small value goes down. Gerald Ford finishes his term for him and sees some return. Jimmy Carter, some good return during his years. Reagan, good return during his years. George H.W. Bush, a little bit of return. Bill Clinton, a dollar goes to $3.56. W, a dollar goes down to 79 cents. And Obama's first 4 years, first 3 years, I guess. We didn't have a 12 in there yet. A dollar goes up to $1.48. Dollar grows. despite the administration over all the years. And you add them all together. With the GOP in the White House, the average return is positive 5.09. That's the number at the bottom here. 43.17 years was the number of years that GOPs controlled the White House. The Dems controlled the White House pretty much the same period of time, 43.58, just a hair more, and an average return annually of 14%. This we've confirmed as a typo, but I have to get it corrected through compliance, so the number for the aggregate isn't nearly as high, but the 13.99 is accurate as an annual rate of return. So is there a causation here? Do we want to elect a Democrat because we want better returns? There's no causation here, but for those who would say that the Democrats are going to leave you with a lesser stock market return, it isn't true. Probably having little to do with who's in office. You know, the pressures are, they're always inheriting something, right? So the one president inherits something from another, and they're always talking about what they inherited if it was negative and what they did if it was positive, and so it's just impossible to track all that. We'll look at the House. We'll do this more quickly. GOP controls the House. Dems control the House. GOP controls the House for a couple of years. The Dems control the House for a few decades. The GOP controls Dems, GOP. So this is the House of Representatives. This is who currently controls the House. The GOP, and you look at the returns, those are the same numbers. And the nominal returns total 4.77%. They controlled the House 22 years out of the total. And 11.29% for the Dems. They controlled the House 63 years for the total. Interesting information. Again, not causation, but interesting nonetheless. This is the Senate. And the total numbers are the same. And finally, the GOP gets 9.87, and the Dems get 9.78. Finally, the Senate for the GOP wins out. They lost everything else, but they win out there. So again, I can look at these numbers pretty benignly. I don't consider myself a Democrat or a Republican, but it's interesting nonetheless. It might or might not be what you're looking at. So we look at all the news and all the rhetoric and everything that's put out there in front of us. Essentially, all of these notions and all of these news articles are there to get something done. The politicians need you to feel a certain way to get you to vote a certain way. Many other sectors, the media sector, for example, needs you to feel a certain way so that you'll watch through the commercial. The internet and Drudge Report needs you to feel a certain way so you'll click, because they get paid when you click. And all of it is there and out there, and it actually affects us. That's the thing that's wrong about it, I guess, if you want to call it wrong. People can put out there whatever they want in a freedom of speech situation, but it affects us. We listen to it, right? And we feel a certain way when we hear that there were jobs lost, or when there's a downturn coming, or something collapsed. They don't say the market went down a little. They say it collapsed. And they don't tell you that it recovered all the way either. They just gloss over that one. These are actual headlines from 2008. This is going to hurt. This is the healthcare stuff. Out of work in America. So this is answering the question. These are the last 4 years. America's vulnerable economy. This is the kind of stuff they do to us. And this is The Economist. I mean, they too need to try to shock you into spending $4 on their article so that they can sell ad copy, right? And they can tell somebody how many millions of people read their magazine. Drudge Report, 1.5 trillion in new taxes, all shock and awe. We are socialists now. That's Newsweek. That'll make some of you glad, and that'll make some of you really nervous. I came up with a quote or two from a couple of books I'm reading. I thought I would read them. This is a little game called When Was It Written? If I can find it quickly. I'll give you the author of it. So, when was it written? Here's a quote. One striking fact illustrates the success of socialist ideas, namely that we have grown accustomed to designating as socialism only that policy which aims to enact the socialist agenda immediately and completely, while we call by other names all movements directed toward the same goal, but with more moderation and reserve. And we even describe these as the enemies of socialism, This could have only come about because few real opponents of socialism are left. When was that written? What decade? I'll read one more by the same guy, and you can keep thinking. The world is split today into two hostile camps, fighting each other with the utmost vehemence: communists and anti-communists. I'm going to get this wrong. Magniloquent rhetoric to which these factions resort in their feud obscures the fact that they both perfectly agree in the ultimate end of their program for mankind's social and economic organization. They both aim at the abolition of private enterprise and private ownership in the means of production and the establishment of socialism. These are pretty harsh words about the economy and what those in charge are wanting to do. Any guesses as to when they were written? 90, 80, 50s, 40s, 50s? Yeah, this is von Mises. So this is Ludwig von Mises. He's an Austrian economist. That's an economic structure that I see myself most in tune with. And he writes this stuff as if it's fully there. And these were the prefaces to the U.S. version. So this was something he wrote in the 40s, his books, and then when they came to the U.S. 10 years later, he wrote these treatments. And so socialism is not new, and some people are a little worried about all this government regulation and all of the new changes that are coming, and healthcare now being managed potentially by the government and no longer privatized. And will this change stock returns? There is no correlation, and more importantly, it's not that much more socialism than we've had for the last number of years. Speaking internationally, it's not really all that different. Now again, I don't want to belabor the point and get into the minutiae and details. This can be a really hot topic for people. It can make people really anxious and nervous. But this is the stuff we're hearing and seeing. The age of volatility, what we spend. This is a nice title, The Extremes of Extreme Couponing. Wow, that's great. Time Magazine, good job for nailing that one. More stats over the last 4 or 5 years, more on food stamps, more on welfare. The national debt rises, unemployment does not decline, and yet the growth of wealth, GOW, from the beginning of Obama's tenure is positive over the 3 years. A dollar turns into 1.87. Matson Money Performance. This is our most conservative fund. These are actual returns net of fees. Okay. Oftentimes we talk about what did the market do during this period. This is what Matson Money did. Now those of you who are invested with us, Matson Money is the free market fund group that we work with by and large. And their return, net of fees, grew $1 million in December of '92 when the Matson Money Fund was started to $2.1 million. This was the most conservative fund that has only 25% allocated in the stock market. So a lot of retirees and folks who just have maybe a pension fund that needs to be positive most years. This is a fund that they choose. This is the moderate fund. This is a fund that has 50% in the stock market and 50% in the bond market, short-term bond market. And this fund grew $1 million to $2.8 million net of fees during that period of time. This is what would be in your portfolio over a 20-year period of time. And this is what the market did. The market did this. Now, almost nobody gets this return because they're constantly chasing after returns of stocks, of mutual funds that did beat the market. But the market is doing tremendously well. You do not need to beat it. You can be in the market, get its return, and be extremely well off over long periods of time. And you don't need to chase around and play the game. This is our growth fund, 75% allocation to stocks, bringing the portfolio from $1 million to $3.3 million. And this is, obviously, I talked about this one, but this is the loss of buying power, if you will. So what does $1 million feel like 20 years later? 1.6 million feels like $1 million. So the net gain is really what we're going for. That's why we advocate staying in the stock market for the rest of your life, because you really need that gain over the cost of goods. And then very volatilely, the aggressive fund, this is 95% stocks, 5% fixed income and cash. And this fund, the pure market, grew $1 million to 3.7 million through June of 2012 from October of '92. So very, very good returns over the last 20 years. And this is not what you'd expect based on what you've been through and and based on what the articles and the headlines are saying and telling you. And again, the rhetoric is there for a purpose, and it is not your returns. The politicians don't care about your returns. They want you to get a nice return. I don't think they're mean people, but they have their agenda. They're trying to sell you something. The advertising agencies are trying to sell you something. Everybody's trying to sell you something. What you need are the facts, and the facts is that the market does a tremendous job growing wealth over time. We need to be disciplined to accept it over time. So we are going to take a break, and I'm going to finish up with one shorter presentation after bread pudding. So whoever wants bread pudding, it should be ready.